Welcome to the Bookkeeping Puzzle. Lesson 7. Source Documents. What we'll learn. What a source document is. Why they're important. Types of source documents. Information included in the source document. How they're used. What are source documents? Every time a business spends money, makes a sale, or exchanges something of value, a financial transaction occurs. But bookkeepers don't just record these transactions based on memory or guesswork. They rely on hard evidence. Source documents are the original physical or digital records that prove a financial transaction actually took place. They are the starting point of the entire accounting cycle. Why are source documents important? Source documents serve several critical purposes in bookkeeping. Evidence: they prove that a transaction happened, when it happened, and for how much. Accuracy: they provide the exact details needed to record the transaction correctly in the accounting journals. Audit trail: if an auditor, tax authority, or business owner wants to verify the financial statements, they trace the numbers back to these original documents. Common types of source documents. Here are the most frequent source documents you will encounter in day-to-day bookkeeping. Cash receipt. Generated when a business receives cash or a check from a customer. It proves that money was collected. Sales invoice. Sent to a customer when a sale is made on credit, the customer will pay later. It lists the products or services provided, the total amount due, and the payment terms. Purchase invoice. A bill received from a supplier for goods or services bought on credit. It shows what the business owes to another company. Bank statement. A monthly summary provided by the bank that lists all deposits, withdrawals, fees, and interest earned. It is used to verify the accuracy of the internal cash records. Check stub or electronic payment confirmation. Provides proof that a payment was made to a vendor, employee, or other entity. Purchase order. A document sent to a vendor indicating the types, quantities, and agreed prices for products or services the business wishes to buy. While it triggers a future transaction, it becomes part of the source documentation chain once the bill arrives. Key information found on a source document. To be useful, a source document must contain specific details. When reviewing a source document, a bookkeeper looks for the date of the transaction, the names of the parties involved, the buyer and the seller, a unique identifying number, such as an invoice number or check number, a description of the goods or services provided, the total monetary amount, including any taxes or discounts. The bookkeeping flow. The life cycle of a transaction always begins with the source document. A transaction occurs. A source document is created or received. The bookkeeper analyzes the document to determine which accounts are affected. The transaction is recorded as a journal entry. The source document is filed away securely for future reference and verification. Without source documents, bookkeeping is just a collection of unverified numbers. They are the foundation of reliable financial reporting. Now, you know the importance of source documents and how they fit into the bookkeeping puzzle. Onward bound to Lesson 8.